When we think about the healthcare sector in the stock market, big pharmaceutical companies, health insurance plans, or medical equipment makers usually come to mind. But what if I told you that the best healthcare business model might not be for humans? Today, we're going to dive deep into Zoetis, ticker ZTS, the undisputed global leader in animal health. This company spun off from Pfizer years ago to become a powerhouse of profitability, innovation, and competitive advantage. In this video, we'll break down the investment case for Zoetis. We'll understand why it has more pricing power than human pharma, how it dominates the pet and livestock sectors, and, of course, what the real risks are that could bring this stock down. If you're looking for a premium quality company for the long term, stick around until the end. The industry, the secret of cash pay. To understand Zoetis, we first need to understand why the animal health sector was overlooked for so long and why that was a mistake. In the past, these businesses were just small departments within giants like Pfizer or Merck. But the dynamics here are much better than in human health. Let's look at the big difference. Pricing power. In human health, who's in charge? Health insurance plans and governments. They have huge bargaining power. They force the use of generic drugs, deny coverage, and squeeze the profit margins of pharmaceutical companies. In animal health, it's a different story. The market is broken up into many smaller parts. Who buys? Vets, pet owners and protein producers, farmers. How do they pay? Up front, cash pay. There's no universal NHS for dogs or a giant insurance company negotiating for millions of cats. This gives Zoetis incredible bargaining power. The end customer doesn't have the power to demand huge discounts. Plus, the cost of developing veterinary drugs is much lower and faster than in human medicine. Economic Moat, the Zoetis castle. Now let's talk about the economic moat. Zoetis isn't just big, it's protected. The idea here rests on three main pillars of competitive advantage: intangible assets, patents, and brands. Pillar 1, patents and R&D. Zoetis holds over 5,280 patents, with another 1,500 pending. To give you an idea of the scale, that's about 900 more patents than its main independent competitor, Elanco. And these aren't just any patents, many are composition of matter patents, which offer the strongest legal protection possible. Pillar 2, freedom to innovate. Unlike competitors who are still stuck within big human pharmaceutical companies, Zoetis has complete freedom. While others try to adapt a human medicine for a dog, Zoetis develops specific molecules for unmet animal needs, like canine dermatology. Zoetis's R&D productivity has historically been superior. Pillar 3, brand trust, switching costs. Think about Rimadyl, an anti-inflammatory for arthritis. The patent expired 30 years ago, and yet pet owners still buy the Zoetis brand. Why? Because the vet recommends it and the owner trusts it. A pet is a family member. You don't want to risk giving an unknown generic to your four-legged child just to save a few bucks. This creates a huge barrier to entry. Growth drivers, the pet humanization idea. Where will Zoetis grow? The answer lies in society's changing culture. We are living in the era of pet humanization. The dog no longer stays in the yard, it sleeps in the bed. This dramatically increases the owner's willingness to pay for expensive treatments, such as oncology and dermatology for animals. The product mix. The company expects the companion animal segment, dogs and cats, to account for more than 70% of total revenue by 2029. Why is this good? Because this segment has higher profit margins and is more stable than livestock. Innovation in monoclonal antibodies. Write down these names: Cytopoint, Librela, and Solensia. These are biological therapies for pain and allergies. It's very difficult for competitors to copy these. Biosimilars are complex. Zoetis is creating an ecosystem of treatments for chronic pet diseases, arthritis, kidney, heart, ensuring recurring revenue for years. financial strength and profitability. It's no good having a great story if the numbers don't add up. But at Zoetis, they add up with plenty to spare. The company maintains a gross margin advantage of almost 1,300 basis points, 13% above Elanco. This shows efficiency and pricing power. Management's goal is to get the adjusted operating margin to 40% by 2029. How? By selling more expensive products for pets and being more efficient in their factories. In 2015, they took on debt to buy Pharmac and assets from Abbott. There was fear. But look at the execution. In 7 years, they reduced the debt-EBITDA ratio from 5.1 times to less than 2 times. Interest coverage is 13 times. This means the company is a cash-generating and debt-paying machine. The balance sheet is rock solid. Capital allocation and ESG. What does Zoetis do with all that money? Their capital allocation is outstanding. 1. Smart mergers and acquisitions. They don't just buy for the sake of buying. The acquisition of Abaxis allowed them to get into diagnostics, machines that are in vet clinics. Buying Pharmac put them in the lead for aquaculture, fish, which is the future of food protein. 2. Shareholder returns. They pay a small, but growing dividend. And most importantly, share buybacks. Management has been smart, speeding up buybacks when the stock drops and becomes undervalued. There are still billions authorized for future buybacks. In terms of ESG, the risk is considered low. There was concern about antibiotics in the meat we eat. Zoetis got ahead of this, sold its medicated feed additive division, and reduced this exposure. The biggest risk today is product governance, medicine going wrong. But the financial impact of this on animals is much smaller than on humans. The bear case. Risks and uncertainties. Not everything is perfect. A smart investor needs to look at the downsides. What could go wrong with the Zoetis investment idea? Risk 1. Economic recession. Even though people love their pets, if we have a brutal recession and high inflation, budgets get tight. In the Great Recession, we saw a drop in vet spending. Also, crises can lead to more animals being abandoned. Risk 2. Product safety, Librela. There are recent concerns about side effects from Librela, a pain medication for dogs. If this leads to regulatory restrictions in the United States, it could affect expected growth for 2026. Risk 3. Long-term trends, veganism and lab-grown meat. Thinking decades ahead, if the world goes vegetarian or lab-grown meat takes over, the demand for medicines for cattle, pigs, and poultry will plummet. Zoetis knows this, which is why they are rushing to rely more and more on dogs and cats, and less on cows and pigs. Conclusion: to wrap up our idea, is Zoetis the Apple of animal health? Maybe. It has 1. Undisputed market leadership. 2. Innovative products protected by strong patents. 3. Loyal and spread-out customers, pricing power. 4. A strong balance sheet and excellent capital allocation. Risks exist, especially related to the broader economy and new product safety. But the company seems well-positioned to grow profits at a rate of 10% per year in the long term, driven by the love we have for our animals. If you're looking for quality, predictability, and a sector with strong long-term tailwinds, ZTS deserves a deep look for your portfolio. What do you think? Does the risk of recession scare you, or is pet humanization an unstoppable trend? Let me know in the comments. Don't forget to like and subscribe for more in-depth analyses like this one.